When it comes to the yen, really, I mean, what is there to do? You might as well just wait, right? The PBOC, Japan should just wait because it is really about the Fed.
It is. So I do want to mention that it's not necessarily just about the yen decline. It might be more a story of a dollar strength. And that's really coming from the fact that the recent macro data in the U.S. is so strong in some ways that you really don't expect a rate cut any time in the horizon. So a lot of the currencies, the currency pairs, like the dollar yen, you are seeing the yen decline, which has been the path of least resistance for the yen for quite some time. So we don't expect really an intervention anytime soon. It seems like 164 is that technical break. That could be the one. The thing that I'm really looking forward to in this particular instance, and there's some credence to it, is that in April, May, when BOJ did intervene, they did it via, funding it via selling treasuries. That's at least what the foreign reserves, data indicates. And that is important because we are living in a rate-driven world, and that puts upward pressure to U.S. rates. So that's really what my concern is, looking at the world from a dollar lens.
So in terms of currency pairs, how do you play the yen? Where do you get the most out of the weakness in this currency?
Yeah, I think the weakness is really driven by the fact that, a lot of as we were talking, the other parts of the world have probably had a much more powerful forces when it comes to inflation. It's heartening in Japan to have inflation, but the forces are not as powerful as in the rest of the world, especially when you're looking at from a U.S. perspective. So the Fed, the ECB had to increase rates much more aggressively, last couple of years than what you saw from the other third anchor bank, which is the BOJ. And I think that's probably one of the reasons why we see that. The other thing is in Japan, we see the wage negotiations. We see this higher uptake in income. That hasn't really translated much into consumption data. I think that is a big difference in the U.S., where the wealth effect, the income effect is actually translated into a higher degree of consumption, and the propensity to consume in the U.S. is quite high compared to, I would say, Asian economies, especially Japan.
Is it fair to say that the euphoria over Japan has dissipated? If you take a look at the positioning in Japan, we've seen foreign funds pulling the money out for the last 4 weeks in a row. Is that just a matter of taking money off the table, locking in profit, or is there more than meets the eye?
I think, Haslinda, it's more of a tactical play. I look at the way we are managing accounts for our clients. I think you could see that the run-up has been quite strong in Nikkei over the last couple of years. A year basis, pretty much same as the U.S. stock market. Given the cautious approach of the BOJ, given what's happening in the FX markets, maybe on a tactical basis, come the mid-year point, you want to rebalance your portfolios, take some away. But I don't think that the structural story, the mid to long-term story for Japan, which has gone an underlying swing on the positive end, has changed much. So we are still slightly overweight on our Japanese call versus our neutral allocation.
As much as we're not expecting actual intervention, the possibility is still there. And should it happen, Japan would have to perhaps sell its holdings in treasuries to fund intervention in the yen. What are the implications of that? Because we're already seeing China, for instance, selling its holdings in treasuries as well.
Yeah, the good thing if you're a dollar owner is that there are other players who are entering and buying U.S. dollar. So even though the two of the biggest foreign reserve holders of the U.S. Treasuries, which would be Japan and China, are somewhat sort of lightening up on their allocation, I think there are other players entering it, which keeps the dollar on a relatively high footing. Having said that, I think that's something that one should take note of because there is a way of funding these sort of interventions, which usually comes from a dollar sell-off. I think in an election it's also plays a big role, because I think the incumbent administration would like to see a little bit more of a rates on a more favorable side for the markets, and I think that goes against what the administration might want to achieve, because when you have more supply of dollars, obviously it puts upward pressure on the yields.
We talk about how it's all a function of the strong dollar. How long can this strong dollar persist? I mean, it was a story that was supposed to be, to be wrapped up by the end of last year. It's persisted through the middle of this year. How much longer will the dollar stay strong?
I think it's, again, Haslinda, I think it's a function of how strong the data is. You've started to see some cracks appearing, and what I'm looking really closely would be the labor market statistics, because that's where you start to see the first leg of softening of the economic data. Hence, the the unemployment claims number, for example, the JOLTS data, which is the jobs turnover data, kind of important. We have started to see that the interest rate sensitive nature of the market, so be it housing and manufacturing, have started to soften up a bit. However, the services aspect is still very strong in the US. So at some point, that cautious ability, and you're seeing it from some company reports as well, that people are getting price and value conscious. Those are the kind of things that you would like to see, which would give credence to Fed to start moving into this, cutting regime, which we don't think is going to happen at the July meeting. Most likely September is a live meeting for the rate cuts.
Deepak, to be honest, there's so much noise out there. Is it just about the data? I mean, what do you take seriously? What don't you? I mean, there's geopolitical concerns, lots of elections still happening, data all over the world. What do you pay attention to? What's noise and what's not?
Well, a lot of it is noise. So I think, if you look at opinions, that can be a little bit nerving if you're an investor. But if you look at the facts are quite positive. And I think if you're focused on the facts, you need to go to the source of where the sources are coming from. Now, the facts tend to say that the post-pandemic era, this is a disorderly decade in some ways, and the business cycle is a little bit off, not compared to the way it used to be, right? We're still in an inverted yield curve in the US, and there's no talks of even a slowdown. So it just tells you that things are a bit different this time around. So you need to be a bit more, cautious in your approach, since still be constructive. Because we have some really powerful forces, be it decarbonization, be it AI, and I can go on and on, Haslinda, that is really changing and bringing these animal spirits back into the market.